So welcome everyone. We do have a very interesting table today, and we have a lot of speakers from different angles. So from academia, from practice, as well as policy making. We do have some people like so people will be speaking on their personal capacity. Andrea Laura Riccardi, that she's from the Uruguayan Tax Administration, but she will be speaking in her personal capacity. I just introduce, we had last year also, before the side-by-side agreement, we had a roundtable where we were discussing what will be the consequences of the side-by-side agreement. And we tried to see what was going to happen and the issues in respect of the EU, other countries, and in general, what will mean for the Pillar 2. And we decided together with Peter Hungler here, the partner in crime, I say, with all these roundtables, to try to organize now after the side-by-side agreement, what has happened, what is the position of the countries, are there any EU issues, the future of tax incentives, QDMTTs. So you all have the program, and we do have a very packed schedule, but the reason is because we want to give as comprehensive as possible. So we will start with Peter Hungler, an academic perspective, and then Edwin Fischer, practitioner perspective. And then after we will go to the EU dimension. And then after with Martin de Wilde and Philip de Belva. And then we will have tax incentives at QDMTTs, where we have Andrea Laura Riccardi from Uruguay, Jerome Montenegro from Stockholm University, and Sunil Pangham, tax advisor, Pangham Legal. And then after we will finish with geopolitical balance. So what happens with the countries and what other economies will ask. And of course, we cannot forget about India. We cannot forget about Brazil. So we have also two speakers. So thank you, everyone. I will say, if you have any questions, just please make sure that you put it on the chat. There will be enough time for questions, but in case of you are having any questions while the presentations, just put it on the chat. I start with Peter Hungler. Peter, please, the floor is yours.
Yes, thank you, Irma. Can you hear me?
Yes, we do.
Good, great. So I tried to give you a very broad overview on the consequences of side-by-side to get things started today. Now, I started some design failures and discussed why these design failures will lead to different legal proceedings around the globe. Briefly address the macroeconomic perspective in which we are right now, the US tax system, and then at the end, I try to explain why you should not be on the wrong side of a side-by-side system. So let me start with the design failures, because many things that we will discuss in the next 3 hours, I think are triggered by the following 4 design failures, at least when it comes to the legal risks of side-by-side. First of all, we have a rule of law problem. Why? Because side-by-side and Pillar 2 in general forces us to apply a very dynamic approach, and in a variety of ways. First, if accounting standards change, we should just accept that as countries joining Pillar 2. But also, if the OECD publishes new guidelines, of course, we just have to follow them. Otherwise, we run into risks of not being compliant. Second of all, there is no international treaty. Third, we do have in many jurisdictions, in particular in the European Union, a competence problem, a competence question that is triggered by Pillar 2, and we do not have a proper institutional base to further develop Pillar 2. So what will be the legal risks here? I think depending on the constitutional framework, we will see some legal proceedings arguing that Pillar 2 infringes the rule of law, as it's not the legislator anymore that determines the tax base, but maybe an accounting setter abroad, but also maybe the OECD or the inclusive framework. Second of all, everything I think here is well known. The UTPR potentially, but also the IIR might infringe tax treaties. And depending on the interaction between domestic law and treaty law in different jurisdictions, we might see legal proceedings also on the treaty front. Third, and I think that will be addressed by others today, we do have a competence question in several jurisdictions, in particular in the European Union, whether the EU was at all competent to implement Pillar 2 directive. And last but not least, we do have legal proceedings in relation to this missing institutional base. I'll just give you an example. There are some jurisdictions, like my own, Switzerland, that refer directly to the model rules. So they have transformed the model rules into national law without really writing a new law, by just by a reference provision. And now, for instance, on the safe harbor provision, it's interesting to see that actually a safe harbor under the model rules would require that there is something called a GLOBI implementation framework, because that's a condition. It needs to go through the GLOBI implementation framework. But there is no GLOBI implementation framework. It was promised that the OECD and the inclusive framework develop clear rules on who approves new guidances, but we have not in place such a GLOBI implementation framework. That means for jurisdictions that directly refer to the model rules, they have a problem, because the safe harbors would actually require a GLOBI implementation framework that is not existing. Now, in the European Union, we have a different question here that might later be addressed by other colleagues. So let me talk about the macroeconomic perspective, because we are in a special situation right now. We are in the midst of a fiscal crisis. Maybe people have not yet really realized that, but that will just accelerate over the next couple of months and years. And it's a dangerous environment we are in. Here, as an example, that's the interest rate for 10-year UK bonds, governmental bonds. And here, really, we are at the magic threshold of 5%. But in particular, for our case today, it's important also to understand that the US has, just increased the fiscal deficits significantly over the past years. Now the annual deficit is even higher than during the financial crisis. And that triggers also interesting questions under a side-by-side system. A third or a second macroeconomic problem that we mainly face in Europe is that we have a growth problem. So the European Union and many jurisdictions in Europe, they have a growth problem. And here in front of you, that's Germany. Now, why is that graph here particularly interesting? Because it shows you the impact of demography on growth rates. So the orange part here, that's the labor volume. And you see in the years beginning 2025, Germany starts with a negative growth rate of 0.5%, just due to the fact that more people get retired than come into the labor market.
Peter, now, why we do not see the slides. Sorry, we do not see the slides. It may be a stop. So, yeah.
Okay. Sorry. Can you see it?
We see it, yeah.
Sorry, no worries. Yes, so that's a problem we have in many jurisdictions in Europe. We have a growth problem. And if there is a growth problem, we need to deal with the consequences. Either we cut spending or we look for new options to create growth. But that is very difficult right now due to the demographic situation we are in. Now, if we look at the side-by-side system, I think it's important to briefly talk about the US tax system and what has happened over the past years. And there are other people in the group here that are far more experts than myself on the US tax system, so let me be brief here. Under the OBBBA, so the One Big Beautiful Bill Act, several provisions are very important or have either been implemented or have received significant amendment that will lead to a very competitive environment in the United States. So if you look at 10K data of the financial disclosure data of US multinationals, you see that a variety of provisions have a huge impact on the effective tax rates. The accelerated depreciation is such an example, but also the FDDEI. The FDDEI is the new FDII, which is basically a very low tax privilege on foreign income. So it has become very attractive to account for foreign income directly in a US entity and to go for the FDDEI system. So tax rates there can be significantly below 10%. But also the corporate alternative minimum tax in the United States has received some amendments, mainly through administrative/executive guidelines. So what's going on right now, at least that's my reading as a non-US tax guy, I think the Trump administration really pushes the accelerator on the competitive front. So we have a side-by-side system where one side is pushing competition and the other side is basically bound by 8%. I think that's important to understand. So do we see some evidence of that? Yes, I think we see some evidence of that. I think here it's quite an extreme example. That's Amazon. And if you look at the financials of Amazon for the last 3 years, two things are, I think, impressive. Let's call it that. On one hand, you see the current US federal income tax burden, that's the top line there, has decreased over the past years, although income has increased significantly. So that means the US federal income tax system has become a lot more attractive. At the same time, what we see at the bottom, there is a shift from international income to US income. So it is nowadays much more interesting for US multinational to account for US income, not for foreign income, i.e. accounted for in foreign institutions. So that's, I think, the development that from a global tax policy perspective is key to understand. There is, I think, a very well done website of a non-profit organization called ITEP, and they looked at all 10K data. And here are just 3 examples of the famous tech companies where you see that they have very low current federal income taxes, significantly below the 15%, even below 10% in some cases. So that brings me to my last few slides. Don't be on the wrong side. So if you have a side-by-side system, you want to make sure that you are on the right side if one side is a lot more attractive. And I think this is what's going on here. We have the US side that is a lot more attractive than the EU plus side. Why is that important? Because US multinationals are by far the most important investors around the globe. If we look at market capitalization of the largest 200 companies in the world, around 70% are US companies. That is sad for Europe, but it's just the truth. So it's really about US companies. It's about being attractive for US companies if you want to increase your foreign direct investments, if you want to increase growth due to technological development. Now, what does that mean for side-by-side? And I think I use this slide here to close my remarks. And let me see whether it works. Can you see, Diama?
Yes, we do.
Okay. So I think we have not just 2 sides, but we have 3 sides. One side is the countries that have not implemented Pillar 2. Not at all. No QDMTT, no IR, no UTPR. Now, for those countries, it might be very attractive in a side-by-side system to receive US investments. Yes. Why is that? Well, because there is no QDMTT and the alternative minimum tax in the US applies a global blending. So you might be able to offer, tax rates below the 15%, but maybe you're not attractive for EU multinationals. Why is that? Because there will be a top-up tax in an EU environment. The second side, is the US. Within the US, we have a significant growth of the economy still. We have the largest global companies. We have right now a lot of innovation, but we have a non-sustainable fiscal state. And all of that, I think, is important to consider. Right now, it has not yet been proven negative for investments in the US that the fiscal state is not sustainable. But that can change over the next couple of years. But right now, I don't really see that effect that the US is not attractive for investments due to the fact that the fiscal state is non-sustainable. And then we have the third group of companies, and these are the EU plus countries that have implemented Pillar 2. And in these countries, we see in many of them structural low growth. They are not attractive for foreign investments due to QDMTTs and UTPRs. And there is fewer global relevant firms in that group of countries. Now, what will happen? And what will happen because of the legal risks and because of the side-by-side system? I think we will see two movements, and then I close. First movement, we will see some countries that will, because of legal risks and because of competitive pressure, come to the conclusion it's not worth anymore to continue with Pillar 2 rules. And of course, here for the EU countries, that's much more difficult because there's the directive. But for countries outside the European Union, I think side-by-side has led to more pressure to get rid of Pillar 2 rules. So we will see a movement from these group of countries to the non-Pillar 2 countries. And there will be a second movement, and that's the movement from non-Pillar 2 countries to countries that are protected under a side-by-side regime. Why is that? We have all heard the rumors that there are other countries like China, India, Brazil that want to apply a side-by-side safe harbor, or at least a UPE safe harbor. Now, why is that important? Well, the more countries move into the US side, the more detrimental it will become for those countries that still apply Pillar 2. That leads to my three conclusions. First of all, I still, and I've thought that from the beginning, Pillar 2 is doomed to fail. Why? Mainly because of the design failures that will lead to a lot of legal proceedings, but because of the devilish combination between an attractive US tax regime and Pillar 2, and because of the legal risks and the movements that I've just explained, I think pressure will be significantly higher on the European Union to abolish Pillar 2 directive if it is not already challenged in court. Now, Irma, I've reached my time to close here. Thank you.
Thank you so much, Peter. I think that this follows really the kind of concerns regarding the Pillar 2 also for other countries, and the question would be what other countries will do, the ones who do not have Pillar 2, or the ones who want to apply for a side-by-side. So let me just give the word very quickly to Edwin Fischer. He's Deputy Global Tax Policy Leader, the PricewaterhouseCoopers, so he will give us the advisory perspective. Please, Edwin, the floor is yours. Thank you for being here.
Thank you, Irma, and I have one slide to share. I hope you can see it.
Yes, we can. Yeah.
I want to address a few issues, and where Peter already addressed them, I will be brief. The first one is legal certainty. We see lots of changes to the model rules, to the commentary, to the guidance, and that's not self-implementing. Countries have to incorporate that into domestic law or guidance or rules. And that's happening in a different pace. That leads to a lot of complexity on which we touch base later on. The side-by-side system is not in the domestic tax systems of most countries that have signed up to the model rules. So that is an issue for the practice. And we'll discuss that later in more depth. There's the litigation on the UTPR, the Belgian court case, for example. And all those legal flaws that Peter also mentioned have been, I think, addressed in the early stages of Pillar 2. The OECD and the European Union have been warned by lawyers and practitioners that these are real issues. Incompatibility of the UTPR with the tax treaties, incompatibility with maybe the European Charter for Human Rights, as is discussed in the Belgian UTPR case. But also when it comes to top-up taxes for countries that have investment agreements with other countries, the top-up tax might be incompatible or in violation with an investment treaty. And all those issues have been sort of shoved under the carpet by the OECD and the policymakers. And that's their full right to do so, of course, but it leads to a lot of uncertainty and right now. And most recently, we have the common understanding in which countries agree to allow to push back the filing date for the first global information return. That's interesting, that's good, but all a little and too late, you know. And also this package is not self-implementing. And the OECD doesn't say anything about the local filings. So that's legal uncertainty in which we have to navigate with our clients. The next three blocks I want to discuss together: competitiveness, incentives, and QDMTTs. There's lots of concerns when you look at text notes or literature about the impact of side-by-side on competitiveness. That leads to questions, you know, by countries. What's the competitive state of our economy, the rules we have, but also for companies. When they discuss location decisions, where do I need to have and allocate my new production facility or R&D facility? How does this work side by side in combination with the Pillar 2 rules? What does it mean? What scenarios do I have? And the equation gets even more complex, I think, you know, when Brazil, as was alluded to this morning in text notes, will be eligible for side by side. We hear that China is also working on that. It's not noted by policymakers. The Irish presidency of the European Union will push for a Pillar 2 impact assessment. It said, including competitiveness. And also, some countries are reconsidering their position on Pillar 2. Peter, there's an interesting report of the University of St. Gallen, where it says maybe Switzerland could repeal the income inclusion rule and the QDMTT and replace that by a separate domestic top-up tax. So you protect your companies in Switzerland from a foreign top-up tax without binding Switzerland to the model rules. That's an interesting thought that is really seriously considered, and not only in Switzerland, I know. So if this happens, you know, this would change the entire landscape again, I think. When you look at tax incentives, reportedly, the European Union is considering to propose an R&D allowance in the anti-tax avoidance directive as part of the tax omnibus. Quite a number of countries are reconsidering their approach to tax incentives. To mention a few: the Netherlands, Ireland, Belgium, Singapore, Malaysia, Philippines, Hong Kong, Canada, and so on and so forth. So tax competition is far from over. It will have a different shape after Pillar 2. That is my conclusion. What I sometimes wonder, you know, that's the block on the 15%. Is 15% the new 0%? And that's a question that is relevant, I think, for both countries and companies. It could lead to the thought, you know, and Denmark is a country, for example, that recently announced to reduce the corporate income tax rate in order to stay more competitiveness. Are countries that had a 0% rate, but now introduced a corporate income tax, are they now moving to 15%? Question mark, I don't know. We see some movements, we see some considerations in countries. When I look at our clients, given the patchwork of the Pillar 2 landscape and how countries implement it, the question raises with clients whether 15% is the new 0%. And questions, you know, pop up around structuring in order to get the effective tax rate to 15%. And of course, we apply all kinds of safeguards, you know, based on our tax code of conduct, but still it's a question that pops up, that comes up, and that will be discussed in the coming months and years. The threat of Section 899 in the US, I think it's relatively calm now, but it's still looming if countries, you know, move forward expediently with the implementation of side-by-side. Congress is on top of that, so it's still, you know, hovering above the market, so to say. There will be a stock take in the OECD and both the EU. The stock take in the OECD will take place in 2028. It has to be concluded in 2029. And that will also assess unintended effects such as the competitive disbalance or imbalance between M&Es and negative trends in taxpayer behaviors to shift profits. In the EU, it was impossible to discuss or reopen the discussion on the Global Minimum Tax Directive. There might be momentum once there has been a stock take in the European Union. That will take place a bit earlier than the OECD stock take. We hear that the EU will do that in 2027. So there might be a window of opportunity in the EU to rediscuss some of the rules, although it's hard to imagine that the EU will do that without having the backing of the OECD and a change of the model rules. There might be some possibilities to further simplify in the European Union, but let's see. It's hard to speculate and to anticipate on that. Well, one of the most important issues around Pillar 2 is, and for the practice, is complexity. The rules are horrendously complex. And you say, Peter, Pillar 2, it's doomed to fail. I think, it's not a bad idea, but the design is really bad. It faces, well, we face with our clients lots of issues around compliance, also given the patchwork of implementation. And it's getting worse, because multinationals that operate worldwide do not only have to comply with the Pillar 2 rules, but also with NECTI in the US, the replacement of GILTI. Let's assume that Brazil will get the approval of the OECD for their side-by-side system, China too. Then we have at least 4 minimum tax systems that companies have to comply with, which makes life very complex, but also very, very expensive. And that leads to a competitive disadvantage in itself. I think the complexity and the compliance burden when you look at Pillar 2 groups on the one side and non-Pillar 2 groups, on the other side. So that's a real concern for us. I think maybe one word about complexity, and that's the flip side of complexity, that's simplification. I said before, the EU is not seeing a possibility to change the global minimum tax directive because there's quite a number of different views between member states on how to continue with Pillar 2. Estonia, for example, is very much against Pillar 2. Some other countries have real concerns. So if the discussion is reopened on the minimum tax directive, the chances are quite high that countries will never reach unanimity again. But the EU is now thinking of simplifying the anti-tax avoidance directive for Pillar 2 groups. Well, reportedly, the EU will propose to switch off, for example, CFC rules under ATAD and also the earnings stripping rules under ATAD for Pillar 2 groups. That would indeed help very much. But still, we still need simplification of the Pillar 2 rules. And also this new effective tax rate safe harbor is not really a simple one. It's still a very complex exercise to show that you meet all the criteria of this new effective tax rate safe harbor. I think I'll stop here, Irma, and hand over to you again.
Thank you so much, Edwin. I think that is very interesting to have both perspectives and both of them saying these are the problems, the complexity, but also the challenges for countries, and looking at the different issues that are need to be discussed. So we will go to the EU perspective in a second. There is one question in the chat that still says kind of the policy question. So that's the reason why I'm allowing this question right now. If there are any questions, please raise your hand. We have room for 2 questions. Then after we'll go to the EU, and then we have a little more of time for more questions. If there are any questions, please raise your hand. Otherwise, I would just say I will read this question in the chat. If Pillar 2 is doomed to failure in the EU, is this not a failure of the EU own making? Why did the EU agree with the side-by-side agreement in the first place? And I think that I will give it first very short remarks, perhaps to Peter and then to Edwin. Hopefully you see the question also in the chat. So why the EU agree on the side-by-side agreement in the first place? Peter?
Well, I think the answer is it's not easy. Not easy. I mean, I think it's easy because there was economic pressure because of Section 899, and at the same time there was not enough political consensus to abolish the Pillar 2 directive, and that's the result. Yes.
Yeah, I agree with Peter. There was lots of pressure by the US, threatening with Section 899, but also I think this was part of the negotiations on the trade deal between the EU And in the US, you see, that those tax and trade discussions, well, they take place sometimes in the same room. And I think, it was either accepting side by side or maybe seeing the entire failure of Pillar 2. And what I always see, I was at the beginning of the negotiations of BEPS and at the OECD, and France and Germany were always, of the opinion that having an agreement on a global minimum tax was one of the most important topics, from a tax policy perspective. That was from the beginning of BEPS in 2011, 12, and 13. So giving up, the idea of a minimum tax, I think, is to be seen as a political failure. Certainly because many of the players, the politicians and the policymakers that invested a lot of capital into this Pillar 2 agreement are still in their position, with the exception maybe of Germany, where Friedrich Merz has no history with Pillar 2, and he made some remarks that showed that he has less passion with the concept, I think, than some other politicians. But looking at the G7, the G20 countries, there's still too many players active that have invested lots and lots of political capital. So it was either this or I think the full collapse maybe of the Pillar 2 concept. And again, having a floor in tax rates might not be a bad idea, but the way it has been designed is really really bad. I don't have another word for that.
Mm-hmm. Thank you so much. And I think it's also important to consider that when you see, for instance, the omnibus package, actually, they still, in terms of simplification, they will follow what the OECD does in terms of simplification for the Pillar 2. So that also shows that the AU wants to follow what the OECD is doing. So, but then let's go to the AU part and let's look at the challenges, the AU dimension. There are participants for a lot of countries, different perspectives, different continents. So feel free to ask the questions, because what we organize, these roundtables, is also for us to speak and give you kind of the different views and to organize and discuss these topics, but also for you to kind of reflect on what the countries are doing, what your country is doing regarding the Pillar 2, and ask those questions. So I ask you, and I say, be as active as possible. It's not like because it is important to address these questions, and you have here experts from different corners. Okay, so let me just go to the AU dimension part, and we have Maarten de Wilde, Professor Erasmus University, and we have Philip de Belba, Professor KU Leuven. Both of them will discuss on the AU dimension. So let me just give first the word to Maarten. Maarten, please, the floor is yours.
Yeah, thank you, Professor Mosquera. Thank you, Irma, for having me today to contribute to this roundtable. Well, today I have the opportunity to reflect on two developments that at first sight may be highly technical, but which in my view also reveals something on the direction of international corporate taxation on the Pillar 2. And I think much that of what Peter and Edwin already noted will also echo in my story today. So the first is on the QTIs, the qualified tax incentives, in the side-by-side package, and the second is on the EU dimension, Article 32 of the Pillar 2 directive, and how the side-by-side package is being incorporated into EU law, or at least envisaged to be incorporated into EU law. So my central claim, simple perhaps, but also perhaps a little bit uncomfortable. I don't think Pillar 2 is actually eliminating tax competition. It's only restructuring it. And also doing it in a way that, from an economic political perspective, maybe functional, at least in the short term, although asymmetric, as we already heard a little bit from Edwin, and as also Peter already mentioned briefly, is at least from a constitutional perspective, EU constitutional perspective, problematic in the longer term, and then potentially also from a political perspective in the longer term. And this duality, I'll describe it as Pillar 2 having like a Janus phase, an economic political one, and also a constitutional one. And also my introduction will appear as an opinion piece also on Professor Mosquera's, on on your blog later today, this week, or at least shortly. So let's start with the economic political Janus phase. In 21, Pillar 2 was presented as a global minimum tax, 15% floor, that would significantly curb tax competition. But if we look more closely today, of course, tax competition has not disappeared. It's been restructured or displaced, and also interesting, I guess, partly internalized within the Pillar 2 system itself. And that becomes visible when we take a look at these incentives. So if we start with the QRTCs, the qualified refundable tax credits, these credits that popped up at some point reduce the actual corporate tax burden, but under Pillar 2, the impact on the ETR, the effective tax rate, is mitigated, and that is because the adjustment runs through the denominator of the ETR calculation, which increases instead of the numerator reducing. So, for example, if you have 1,000 income and corporate tax of 200 in a certain jurisdiction, the ETR is 200. And if this 200 is credited to 0, instead of 0 over 1,000, 0% ETR, we do something magical, increase the denominator, and we end up with 200 over 1,200, producing a 16.7 ETR in this example. And of course, the implication of that, 0 tax, but nevertheless a 16.7 ETR in this example is important, because the Pillar 2 system is not only like measuring tax burdens, but it's also reshaping them through the way it measures the ETR, which is interesting. So incentives are not eliminated, but they are repackaged, and it also incentivizes countries to move to QRTCs. And I think that's also a development that we also see happening today. And now with these qualified tax incentives, so that were added in the side-by-side package, the expenditure-based, production-based tax incentives that are eligible for QTI, safe harbor qualification, the system moves basically one step further, because to the extent these incentives are QTIs, the effect in terms of ETR calculations of these incentives are neutralized. So these incentives reduce actual tax liability. So for instance, super reduction or an exemption that qualifies as a QTI. But they don't reduce the measured ETR for Pillar 2 purposes up to a substance cap. So there's a cap in. You can subsidize under the Pillar 2 framework up to basically a routine return on tangible investment. So in the example, we have the 1,000 of income and the 200 profit. If we give a credit that qualifies as a QTI of this 200, we have 0 tax and we have 1,000 income. And in the ETR calculations under the QRTC, we still have 16.7. So you see that the ETR is mitigated, the impact of the QRTC, but in the QTI, we just take it out. So we end up with a 20% ETR, regardless. So while the QRTCs operate like within the ETR metric, QTIs are even more magical. They appear and they become invisible in a way, because they effectively are part of the design of the metric. And that shift is, I guess, crucial, because the ETR calculation via this means turns out not to be just a measurement tool, but also more or less of like a normative filter, because of how we deal with QTIs in the side-by-side package, determining which incentives are visible in Pillar 2 and which at some point become invisible. And also interesting, I guess, the no benefits rule. In this regard, we see something similar happening. However, via interpretation, the no benefits rule in Pillar 2 basically says that if a country provides benefits related to the introduction to Pillar 2, that is not allowed, because the idea is to prevent jurisdictions to offset top-up taxes through incentives or subsidies, because under the no benefit rule that could initiate a disqualification by other jurisdictions, and that could have all kinds of adverse effects. And the idea is if you top-up tax, you cannot give the money back in the form of a subsidy. But now in practice, we see that some forms of incentives are restricted, and others, if they are embedded in the transforming design of the Pillar 2 framework, it is allowed, creating almost like more like a governance model on the basis of which under which countries can structure their incentive mechanisms, which is really interesting, and creating something of like a selective constraint Some forms of tax competition are curtailed and others are restructured and permitted. And in the no benefits rule context, that happens via interpretation. And I think the inclusive framework has a little bit of a hard time struggling with the interpretation of the benefit rule because we are still awaiting guidance in that area. But the broader implication is that Pillar 2 is like reallocating, recoding tax competition, creating something externally looking like a minimum tax framework with a floor to tax competitive responses. However, internally, it continues to accommodate competition, almost like via a more or less governance model, for instance, via these QRTCs and QTIs, etc., in less visible forms. And there we have this Janus phase, basically. And of course, that has consequences. For instance, for developing countries who traditionally make use of tax holidays, and that's kind of treaty reliefs, etc. And of course, these mechanisms now become less effective because of top-up tax exposure in other countries. So you see these countries being almost compelled because of competitive pressures to transform their systems as well. And if they want to keep on incentivizing, they need to go to alternative mechanisms, which are more complex, administratively demanding, etc. Something what I would call a cash carousel. First levying corporate tax, top-up tax under Pillar 2, and then giving the money back to business in the form of a subsidy, creating these carousels, which requires, of course, administrative capacity, etc., producing asymmetries because, capacity is not evenly distributed across countries. With developing countries, capacity have jurisdictions and capacity have nots, creating all kinds of asymmetries. And of course, also what was already mentioned was the geopolitical aspect with the US example. Under the side-by-side, of course, US is allowed to use its own minimum tax system, giving it greater flexibility because it's not subject to the structural constraints on incentives. The QTI is capped with this substance cap, and we don't have an equivalent, as far as I know, in the US system, giving them greater flexibility to incentivize their business investment under the corporate tax system without any top-up tax implications because of it being shielded under the side-by-side system. So what emerges here is not a neutral worldwide global minimum tax system, but a system that is politically contingent and is also politically contingent distribution of competitive space. And in the EU context, we see the dynamic as well. And the omnibus package that was leaked was already mentioned, where introducing these incentives as part of the competitiveness program and the agenda, and also as a coordinated anti-avoidance architecture in the ATAT context. But of course, importantly, because the EU has adopted the Pillar 2 framework, all needs to be done within the policy space of the directive. So here we see that EU member states' policy room is almost endogenous to the Pillar 2 framework. And you and I, we've been working on a paper on tax incentives and G20 countries, also mapping out developments in all these countries. And we see all kinds of interesting dynamics and transitioning into, for instance, QRTCs and looking into the room available to continue competing. So here we have the Janus phase. And interestingly, when I was preparing, I was thinking, okay, how can I combine QTIs with EU constitutional constraints? But interestingly, we have something similar in the EU constitutional context. So when it comes to the EU and the incorporation of the side-by-side package in the EU acquis, communautaire, the EU context, we have Article 32 of the Pillar 2 directive. And there we see a more or less parallel development, which is also interesting. And the key point here is that I was thinking of finding some right words, and I landed on the following: that Article 32 obscures basically the locus of normative authority in the European context, meaning that in the EU context it becomes increasingly difficult to determine where the essential elements of the Pillar 2 system are basically devised and made and created, and also to whom, as an institutional government actors terms, they are legally attributable. Professor Hongler also already mentioned it a little bit on this ambiguity, perhaps. So how does Article 32 of the directive works? We have the EU Pillar 2 system under the directive being implemented on that basis in the EU member states. And then we have Article 32, allowing OECD developed safe harbor mechanisms to be given effect within EU law. And the traditional idea, of course, was of the safe harbors being an instrument to create an administrative ease rather than change the rules. So it's not a straightforward implementation, but what Article 32 of this directive basically does, it introduces something of a circular delegation or a back delegation kind of mechanism where rulemaking authority first is centralized at the EU level with the directive, the Pillar 2 directive, and then subsequently it's effectively re-externalized via member state consensus in the inclusive framework, which is very interesting. So it's like something circular, and that leads to a problem. And together with my colleague at Erasmus, Sam van der Vlucht, who is also working, Dr. van der Vlucht at IBFD, we wrote a paper on it, European taxation, and we refer to it as a catch-22, because the issue that pops up here is the question: how do we legally qualify the side-by-side framework from an EU lens? And then we have basically two options. First is considering the side-by-side implementation in the EU to be part of the acquis communautaire, so part of EU law under Article 32. But then we face a big issue already reported on by Professor Weber earlier this year on the GLOBTAX blog, because we will be confronted with issues under the Mironi doctrine of the Court of Justice. And that basically is already tracing back to the 1950s, an approach of the Court of Justice preserving the integrity of EU law, rulemaking, and the constitutional legal order, saying that essential elements of EU legislative decision-making, legislation, cannot be shaped outside of the EU legislative framework. So if the side-by-side agreement, safe harbors, or basically any other safe harbors are effectively changing the rules, it cannot happen outside of the EU institutional framework, creating all kinds of pressures, of course, when it comes to the binding effect of all these safe harbors. And some say, no, you should look into Article 32 of being like a carve-out, allowing rulemaking outside of the EU context. But then when we say it's member state action, if instead we attribute this rulemaking concept, the implementation of the side-by-side system, to the individual member states acting in concert outside of the EU Pillar 2 framework and also outside of the EU institutional framework, say we consider that to be allowed under Article 32, a new problem pops up because of the state aid law now becoming relevant. Because under the side-by-side safe harbor, the beneficial treatment of one over the other, either via the side-by-side safe harbor, UP safe harbor, perhaps also dependent on the design, the incentives, can constitute all kinds of selective advantages under Article 107 of the treaty on the functioning of the EU, state aid rules. But it's not only bound or inside the EU, we also have the foreign subsidies regulation, basically exporting the EU state aid framework to third countries, when we have third country state aid effectively impacting the internal market. The foreign subsidies regulation is a tool available to the Commission to target basically third countries, for instance. Well, you can think of a few, and that is already put in place in some occasions. I just saw the other day a paper popping up in Tax Notes International on the foreign subsidies regulation and its impact on the side-by-side framework. So also for US headquartered multinationals, perhaps in view of the foreign subsidies regulation, it's not that safe, this harbor. And the problem here is that there is no, so if you go to the EU acquis approach or the domestic member state action approach, both trigger different legal regimes, Moroni versus state aid, but we end up both leading to frictions, and there is no really stable middle ground. And the broader, underlying, deeper matter or question that is popping up here, and that was also mentioned already by Peter in his introduction, is of course the constitutional concerns and legality of taxation, democratic accountability, and also the autonomy in the EU context of the EU legal order, particularly, for instance, echoing all kinds of concerns that are familiar also in the earlier case law of the Court of Justice, for instance, in CADI, about the incorporation of external norms. In that case, it involved the UN Charter. Here we would have the side-by-side package, external norms without sufficient constitutional safeguards, where the Court of Justice said, they cannot have effect in the EU context without such safeguards. So the legal effect of all this stuff devised in the inclusive framework from an EU constitutional perspective, or if I think, well, perhaps we'll have to wait to see what will happen on that when it comes to the assessment of those, because ultimately all these issues at the end of the day cannot be settled politically, but depend on how the court will look at it, and ultimately the Court of Justice. And I think judicial scrutiny will come sooner or later, unavoidably, because any dispute involving the operation of these safe harbors, of course, will first trigger the question as to its legal status, because you cannot have a meaningful discussion on the application of the side-by-side rules before having a discussion on the status of those rules from an EU perspective. So this will come sooner or later. So,
Martin,
yeah.
we have 1 minute.
I'm concluding. I only need 1 minute. Thank you. So I was just saying, let me conclude. So we see the common pattern emerging. Economically, we have Pillar 2 filtering, incentives which are okay, which are not, and then constitutionally similar filters at what part of the rules apply effectively and which do not. So the final claim will be, what is Pillar 2? Not a simple minimum tax. It's a multi-layered, multi-objectives minimum tax, facilitating competition, centralized coordination, however, decentralized implementation, all kinds of, where are the rules made, IF level, EU level, nobody knows. And that is all managed today rather than resolve these tensions. And we see that this management is being done in increasingly complex design choice manner, leading to the final question, perhaps rhetorical, is whether a system that is functional perhaps today to some extent, however, is it sustainable legally and politically over time? And to be honest, I'm not too sure about that. Sharing a little bit of the pessimism I heard from Peter in that regard. Thank you.
Thank you so much, Martin. And I think that what is important is that since we started with academic and the practitioner's view, but also we are confronted with the EU problems in terms of unanimity and in terms of not wanting to go back again to discuss the Pillar 2 directive and then using the Article 32. But before even the Article 32, we also were having a roundtable in the past about the UTPR, where we also discussed the challenges there. And I know that there is some litigation, and Philip will provide us with some views on the litigation in the EU perspective. And then after there are some questions we will try to answer now, after Philip's presentation, and then we have a kind of short break for 8 minutes. And then after we will come back again. But Philip, please, the floor is yours.
Thank you, Irma. Can you see my slides? Yeah, okay, great. Yes, hi everyone. I'm also going to discuss part of the EU concerns regarding this entire setup. And of course, I agree with Martin's comments, and I also think there might be a problem regarding tax legality. And of course, there might be an issue regarding the application of the Meroni doctrine in this case. But I will focus a bit on the Belgian UTPR case, which is pending before the Court of Justice. I will give you a bit of background on the case and also the very latest development in this respect. So basically, we had a case which was brought by the M3 organization, the American Free Enterprise Chamber of Commerce, and they started proceedings before the Belgian Constitutional Court, and they in fact aimed to annul the Belgian transposition of the minimum taxation directive. More in detail, basically Articles 35 and 36 of that domestic act, and in essence, those are provisions governing the UTPR rule. So this is the subject matter of the case. In order to understand where we're currently at, it's also important to note that there was quite a bit of discussion in Belgium regarding the admissibility of this case, because M3 as an organization, it does not represent a single taxpayer, but in fact represents a group. It's an interest group of US companies. Basically, they argued that Belgian entities of US multinationals were hit by the UTPR, and that caused problems, and M3 brought the case before the Belgian Constitutional Court in this respect. Naturally, on the other side of litigation, you have the Belgian Council of Ministers, and they adopted a dual defense in this respect. First, they said, well, according to us, from a procedural perspective, this organization does not have standing because the organization does not show which members are specifically targeted by the UTPR. There's just an interest group. So in essence, they're not really affected by the measure, so they do not have standing before the Constitutional Court. And also regarding the substance of the case, they also raised several counter pleas, which I will also talk about in a minute. What did the Constitutional Court in its first decision on admissibility say? They say, well, basically they confirmed the general understanding in Belgium that there is no such thing as an actio popularis, which means that anyone can bring a case against anything they want, basically to show that you are directly and adversely affected by a measure. In the case law of the Constitutional Court, there are several conditions for a non-profit association like MFRI to bring a case. And according to the court, basically MFRI meets all of those conditions, or at least they met all of those conditions. So they said, well, indeed, the required interest is present, and basically they could bring the case before the Constitutional Court. It should be noted that one of the objections of the Council of Ministers, so representing the Belgian government, was not answered. The fact that they could not really show which specific members were targeted by the tax measure, but that was left unanswered. In substance, the case, and this is the EU angle that pops up, the case revolves around 4 pleas. And I think the first 2 pleas are the most important ones. I will explain in a minute why this is the case. The first plea was that the UTPR as such violates the right to property. And I think several of the speakers here today have already written about the interaction between the right to property and UTPR, and that there might be an issue. And in fact, MFRI raised objections on the basis of national law, the Belgian Constitution, Article 16, but they read it together with Article 1 of the First Additional Protocol to the European Convention on Human Rights, so the right to property, and also on the basis of the EU Charter, which is for the non-EU people in the virtual room, is basically a EU instrument also containing certain fundamental human rights, but only applicable in a purely internal EU context. The basic argument here was that the top-up tax under UTPR places a disproportionate burden on taxpayers because the entity as such is basically threatened into its existence because basically if the entire burden is charged to one single entity, there might be an issue and that entity might not be able to pay the entirety of the tax, and it might even go bankrupt in extreme cases. The Belgian government defends itself on that ground. They say, well, according to us, you need to take into account that the UTPR is merely a backstop. It's only a measure of last resort. So it's of residual nature. So there is, according to them, no issue, and there's also no excessive tax burden due to the applicable rate of 15%. So they try to defend themselves on the basis of this point at first. And I think it's, in essence, the most important point as well. The second one concerns the possible violation of the freedom to conduct a business and the principle of legal certainty interpreted in a very, very broad sense. And I think as Edwin just said, and I think as Peter said, the rules as such are very, very complex. And MFRI argued 2 things. They said, well, basically, and this first point is very similar to the right to property plea. They said, well, a company loses basically its freedom to dispose over its own resources because of this measure, on the one hand. On the other hand, the principle of legal certainty is violated because both the amount of the tax and the allocation are unforeseeable in advance. So basically, there's a lack of legal certainty. Again, the Belgian government dismisses all of those arguments naturally, and they say, well, according to us, the rules are sufficiently clear and they are foreseeable for entities concerned. And there is a case to be made here, in all honesty, because basically there is case law of the European Court of Human Rights saying, well, there is a wide margin of appreciation for tax measures, and taxes are inherently complex. And multinational enterprises are even encouraged to seek tax advice from advisors if they do not understand the tax legislation at issue, which is, of course, a very strange reasoning, but it's the case law as it currently stands. There are two other arguments that were made. First of all, a violation of the principle of equality and the ability to pay principle. A bit on the same grounds, say, well, ability to pay might be at stake in case the entire tax is levied from one entity. That might not be justified, that might not be proportionate for that single entity. And in essence, the Belgian Council of Ministers said, well, according to us, ability to pay is only relevant if you look at one single entity, but according to us, the UTPR is a tax on the entire group, and the tax to be paid is a debt proper to the group. So this implies that related companies might actually aid each other in financing this tax. And the last point was the principle of territoriality. Basically, the taxpayer said that this tax violates rules of customary international law, the nexus principle. There is no real connecting factor to levy such an amount of tax from the entity concerned. And also this argument was, of course, countered, and they said, well, there is, in essence, no customary international law rule prohibiting this kind of levy, in short. Now, what happens with these pleas? The Constitutional Court basically treat them together. However, in the case itself, they only seem to spend attention to the first two pleas, the right to property and the principle to the freedom to conduct a business and legal certainty. The ability to pay and the fiscal territoriality argument were not really addressed as such. And I think the Belgian government is generally very, how shall I put it, at ease, especially with the territoriality argument before the European Court of Justice currently, because this was also not dealt with by the Constitutional Court. Now, what did the Belgian Constitutional Court do? They referred a question to the European Court of Justice, because they are, as such, not competent themselves to test the rules or the validity of the directive against European rules. So the question was, in fact, referred to the European Court of Justice. You see the case number on the slide, C519/25. Now, what are the latest developments here? Of course, as we already talked about, the side-by-side package. Basically, there is a safe harbor that was introduced, and with all the ensuing problems regarding tax legality and the like. But this side-by-side package actually has several implications for the UTPR case, because in essence, it means that the UTPR that was challenged by AmFree no longer effectively reaches US groups because of this side-by-side package. And the question arose whether this reference to the Court of Justice may therefore have become devoid of purpose. What are the very latest developments in this respect? The Court of Justice also took note of the side-by-side package, and in fact, they sent a request in April 2026, so a couple of months ago, to the Belgian Constitutional Court to ask for additional information on this, on the Belgian point of view regarding the question whether this case is in fact still relevant. Last month, in May 2026, the Constitutional Court sent a letter to the parties concerned. So they sent a letter to AmFree and to the Belgian government, the Council of Ministers, in which they said, well, we want to reopen the debates before the Constitutional Court. And we invite all parties to submit additional memoranda showing basically their interest in the case and the fact that the outcome of the case is still relevant to them. And if my information is correct, all parties concerned submitted an initial memorandum a week or two ago. So this is currently still being analyzed, I think, by the Constitutional Court. We shall then refer that information back to the Court of Justice, which will then decide, of course, what to do with this particular case. I think in brief, Irma, this is where the Belgian case is currently standing, and I think, like everyone, I'm very curious to see what will happen with it in the future.
Thank you so much, Philip. And I think that also with the UTPR, some of the issues that the right to property, the international obligations, where international customary law were mentioned in the 2023 roundtable that we organized. And that's the reason why I just put it in the chat. Also, the article on Tax Notes International, what could be very interesting, but it is not even more interesting that almost 2.5 years later, because we are discussing the UTPR and we are discussing at the case level, but at the same time we see also the developments regarding the side-by-side, and then we say, are we going to go back? I just take one question, and then after we will take a break of maximum 10 minutes just to get a coffee and all these things. But we will see. Let me just check. There is a question here from Eduardo Martinez. Eduardo, would you like to ask your question, or do you want me to ask it for you?
Hello, Irma. Thank you very
Hi.
much. Thank you for giving me the space to speak. I just wanted to ask a simple question. To what extent can siding on the right side of Pillar 2 solutions shape the global economic structure, and mainly focused on the countries whose economic growth depends on FDI?
Yeah, I think that could be a nice question for Martin. Martin, please go ahead, and remember that after this, we will also discuss the tax incentives and the QDMTTs, so we may also discuss about investment, but Martin, please go ahead.
Yeah, so the siding in the right side of Pillar 2, I can imagine that for countries that much depend on foreign direct investment is also, I guess, relevant to look into where is the investment coming from? So if it's mainly US investing inwards, or is it mainly EU companies or Pillar 2 implementing countries, then I can imagine as a country, when you are asking yourself, should I introduce like a QDMTT or not? What would be the effect of that? Say I introduce an incentive or whatever. Is it neutralized? And if it indeed is the case that the US minimum tax system gives more leeway because of global blending, etc., vis-a-vis or in comparison to Pillar 2, I can also imagine that countries that depend on foreign direct investment can also strategize on that, because if you're not taxing it yourself and you know it sacks away, then perhaps you have an incentive to introduce a QDMTT and go for a subsidy or whatever. But if you know that much of your foreign direct investment is coming from the US, for instance, and it's globally blended, then you also are not required to introduce a QDMTT and create all kinds of complex cash carousels to stay afloat in the competitive game. So yeah, I can imagine that also thinking of what Peter was mentioning in the three scenarios, side by side or Pillar 2 or nothing, that is relevant to strategize on that aspect as well.
Yeah.
Thank you.
Thank you so much, Martin. And I will give now the word to Philip, because Peter Hongler is asking, okay, but what is your personal assessment?
That's a very good question, Peter. And Peter always asks good questions, of course. Regarding I assume you mean, Peter, about the substance of the case, not about the admissibility discussion.
Yes, and especially also on the last point, on the relevancy question.
Yeah, indeed. Well, I think what I understand, perhaps to give you a bit of background, is that apparently Belgium was not chosen by accident to launch the case. I heard that an assessment took place regarding the measure, and basically Belgium offered the most direct route to pose a question before the Court of Justice. I think the part of admissibility, especially domestically, has been thoroughly reviewed. And in honesty, I think the Constitutional Court in Belgium has never gone as far as it did in this case to recognize basically a complaint from an interest group, or not to this extent of this importance. So this is the first. At the level of the Court of Justice, well, I think the question might, of course, be relevant, of course, for other jurisdictions. Aside from this specific question of admissibility on the substance thereof, I think two arguments might hold water, but they're both, debatable. I think the first one is the right to property. And I'm not solely talking about legal certainty or impact on the specific taxpayer, but I think all of those elements taken together, you have and the legality issue, and the fact that rules are complex, and the fact that it can impact one particular taxpayer in an excessive way, that might pose an issue. I think if the Court of Justice takes a holistic view on the right to property, which it should, according to the EU Charter, read together with the case law of the European Court of Human Rights, there might be an issue. And a second thing that is, I think, a bit overlooked was the argument on territoriality. It was basically dropped by the Constitutional Court. And I've been talking to the attorneys involved, and they also don't think that the part on customary international law is a real argument. Basically, they say, well, it's all fun and games for an academic literature, and customary international law, it's something fuzzy up in the air. I had debates about that, but I strongly disagree with them, because if you look at the case law of the Court of Justice, you will notice, in fact, that they consistently state that even EU legislation needs to comply with customary international law. In case law, they have tested measures against customary international law as well. Admittedly, not in the area of taxation, and not against any rules regarding connecting factors or nexus principles and the like, but they do take it into account. So I think if the Court of Justice will also would also look at that aspect, there might also be an interesting discussion to be held. But in general, I think arguments on the basis of customary international law, enforcing that before the Court of Justice, it's difficult. And I think the most I think the argument with the most chance of success is, in fact, the right to property argument, that there might be an issue there. But it's taxing human rights, and experience learns that courts are very, very reluctant generally to apply human rights to taxes. More and more they do that, but with the right to property, I think if the case is brought in a smart way, stating that we not only look at the substantive impact of the measure, but also at the procedural context, the way in which the rules came into force, the way in which the rules are drafted, then there might be an issue, I think.
Thank you, Philip. And thank you, Martin, Peter, and Edwin. We are going to take just 8 minutes break. Now we are from 10 to 8, but at least just to have a coffee and for people just to change a little. I know it's a long session, and normally we have 2-hour session, but we are doing it because of all the topics we are discussing and the different perspectives. So please stay with us, and we will be back in 8 minutes from now. Thank you. So we go to the third part of this session, this roundtable, where we look at the future of tax incentives and QDMTTs. We have seen also that there is, Martin also gave a short presentation on also what is it as the tax incentives, what are the challenges. Also, Peter Holmgren and Edwin also mentioned that a little. But now we are going to zoom in on the countries and the perspectives. And let's look at, then this is more a country perspective. Let's first have Andrea Laura Riccardi participating in her personal capacity. She wrote a blog once about the QDMTT, No, it's not the right time. So I was wondering, have you changed your mind about that after the side-by-side or not? And then after, we will have Jerome Monsenego, Professor of International Tax Law at Stockholm University. He will also discuss this from the Swedish perspective. And then we have Sunil Panjab. Please go ahead, Andrea. You have 15 minutes.
Okay, thank you. Thank you, Irma, for the invitation. I'm very happy to share with all of you this roundtable, and I'm also happy to see some colleagues from Uruguay joining this roundtable as well. As Irma already mentioned, I'm sorry for repeating, but it is important. I'm participating in my personal capacity, and I'm going to share some of my personal views, which as such do not necessarily reflect the position of the organizations to which I am affiliated. So considering your question, let me say that no, I'm not, I'm still convinced that it is not time to implement the QD entity. But let me tell you that while I was preparing this topic of QD entities and tax incentives for this roundtable, I was reviewing my notes from the roundtable we had in November last year on the June G7 statement and the questions, possible answers and comments I was sharing at that time. And to give some context, I was focusing at that occasion precisely on QD entities and tax incentives because the implementation of a DMTT and the reforms to invest attraction policies, including tax incentives, was the preferred policy choice for those few countries reacting to the GLOBE rules in the region of Latin America and the Caribbean. And in particular, I refer to three aspects. First, the qualification status of the entities. Second, the interaction between the US minimum tax system for controlled foreign company income and the entities. And third, the unequal treatment of tax incentives under the top-up tax calculation. And at that time, I noted that the G7 agreement assumed widespread implementation of QD entities, and for US parent groups, target only the deactivation of IIRs and UTPRs. I recall asking about the consequences of a DMTT that does not apply to low tax constituted entities of US parent groups. Could such a DMTT obtain qualified status? And my answer was no, it couldn't because it could be a conditional DMTT. But the question that followed that was, what could be the consequences of this non-qualification? And at that moment, it was noted that as those CEs constituted entities were part of a US parent group, no IIR, no UTPR would apply. Instead, the US CFC regime former guilty measure would apply, and probably double taxation will arise. But in no case I was questioning the characterization of the DMTT as a covert tax. Now we have the SBS package, and it provides clarity. On the one hand, it states that, and I will read exactly what it says, the qualified status of the entities remains dependent on their consistent and non-discriminatory application to M&E groups, regardless of whether an M&E group has elected to apply the SBS safe harbor. So from this statement, we can conclude that the entity which does not apply to constituted entities of a group with a UPE located in a jurisdiction with a qualified SBS regime would not be a QD entity. So we can conclude that. But the SBS system goes a bit further because it states that the inclusive framework agrees that conditional or discriminatory taxes will not be recognized as covert taxes. Thus, the DMTT would neither be qualified nor recognized as a covert tax. And this will have a significant impact beyond US parent groups operating in the DMTT jurisdiction. This is the non-qualification and the non-recognition as a covert tax will impact other groups by triggering the charging of a top-up tax calculated without considering the DMTT as a covered tax via the application of IIRs and UTPRs. And furthermore, the SBS system also confirms that the QDMTT would continue to be calculated without taking into account CFCs or other owner-level taxes for the calculation of the QDMTT. So no push down, let's say, ratifying then the aim of the GMT, that the aim of the global minimum tax is to attribute primary taxing rights to the jurisdiction applying the QDMTT. So the conclusion here is clear that there is a strong commitment to implement QDMTTs. And this is remarkable considering that this concept of the QDMTT, if you remember, was introduced in 2021 at the very last moment and appeared almost unnoticed in the model rules at that time, and yet now has gained central importance. So having this, having said this, and focusing now on QDMTTs, it is well known by you that its design that must reflect with some variation that of the GLOBE model rules, the IIR and the UTPR, has shaken national tax incentive policies worldwide, and countries have been compelled to redesign these policies. Yet the path forward remains far from clear, and this uncertainty has made the decision-making process particularly complex, as some colleagues already noticed, but for both taxpayers and tax authorities. And first, in respect to tax incentives, the rules provided for a different treatment depending on the type of the tax incentive, favoring certain types of incentives rarely granted by less developed jurisdictions. And the policy reasons behind that different treatment have not always been that clear, that transparent, I would say, for example, with the qualified refundable tax credit. So second, this criteria have been evolving. The last innovation introduced with the SBS package has been with the so-called qualified tax incentives, which at least aligns the treatment of substance-based tax incentives with the preferential treatment of qualified refundable tax credits. And the other unclear element since the approval of the model rules and in relation to tax incentives has been the related benefit requirement for the charging mechanism and the MTTs to secure the status of qualified. And I have always had my doubts if the inclusive framework can grant that a jurisdiction is not somehow refunding the tax or the tax charge via some benefit of any kind. So, and in fact, in this respect, there is a mention in the package that when it addresses the qualified tax incentives, it says that an incentive could be designed so that it formally meets the definition of a qualified tax incentive, but in practice operates to mitigate the impact of the GMT, the global minimum tax. So, and it announces that the inclusive framework will do further work in this regard. Also on another field, we have also, let's say, good corporate alternative minimum taxes. So what I'm trying to say here is that I'm not sure if the complexity of this, that this measure has acquired is worth it. I really would like to see if the time and cost of compliance and administration of all these outplays the benefits the measure is supposed to bring. And in particular, in respect to less advanced economies that for sure have other priorities. And I don't know if I still have some time.
Yeah, you have like 1 minute. Yeah.
Okay, just to comment, maybe the situation of my country, Uruguay, you know that Uruguay implemented a domestic minimum top-up tax of 15%, and it is applicable already for years 2025. The MTT will be implemented by a set of normative rules separately from the traditional corporate income tax law, let's say. On the one hand, the legal text contains a provision according to which this DMTT shall be regulated in such a way that is implemented and administered consistently with the outcomes intended under the GLOBE model rules and the consolidated commentary. But as of today, we do not have the regulation, just the legal text that is basically a copy of the GLOBE model rules, because it is intended to be considered a qualified DMTT. But still we lack important elements such as safe harbors, the mandatory variation related to owner level taxes. It is expected that is going to be amended via the regulation, but we are still waiting. Of course, there is nothing on the SBS package except for a legal provision that establishes that the executive branch shall exempt or exclude for the DMTT those constituted entities located in Uruguay that are part of a multinational group whose UPE is located in a jurisdiction that has been exempted or excluded from the application of the IAR or the UTPR. So you can have your own conclusions on this. It is expected that this is going to be amended, but we still have no decree. And furthermore, the law that introduced the DMTT simultaneously introduced some measures that intend to revisit the tax incentive policy, and in particular introduced a provision that empowers executive branch to grant businesses acting in Uruguay that contribute to the development of certain objectives refundable tax credits. So still no regulation on that, but now we have this special treatment for qualified tax incentives, so we are waiting also their reaction. What I am saying is that I can imagine that it has been very difficult for the government to make decisions on how to proceed when everything is so dynamic and is changing all the time. So I can leave my part there, and I'm happy to answer any question you may have.
Thank you so much, Andrea, because I think that also the perspective of Uruguay and what they are doing also with the given executive powers to give tax incentives is very interesting. So the question is whether other developing countries will be also doing the same. But let me go back to a developed country, Jerome Montenegro. You will present the perspective of Sweden. And it's also interesting because actually a lot of developed countries are also just now being questioned about what will happen with the tax incentives. So please go ahead, Jerome. The floor is yours.
Thank you very much, Irma. It's a pleasure to be here. Well, the topic, I'll try to be short regarding the time. The topic of incentives, of course, has been important since the beginning of the project. And we all know that the GLOBE rules have like different impacts on the incentives, depending on how they're designed. They may increase the GLOBE income, they may reduce the covered taxes, so different types of impact. We have the substance-based income exclusion, which can, to some extent, help you implement incentives and look for them. We have also the choice of having jurisdictional blending, which to some extent is perhaps helpful for bigger countries. You can compensate the ETR of one constituent entity with some other constituent entity, one benefiting from an incentive, the other with no such incentive, as opposed to smaller countries or countries with a tax rate closer to the minimum tax. So I would say the effect of the GLOBE rules has been diverse when it comes to incentives. Then, of course, we have the SBS and the substance-based tax incentive safe harbor. And we'll not get into the details, but then we have like a new architecture. We go from increasing the global income to increasing the covered taxes. We may have an overlap with the QRTCs and MTTCs, but not necessarily. It's a different type of safe harbor in this respect, but nevertheless, it is capped. We have this substance cap, with different criteria, either the higher 5.5% of the payroll cost or depreciation on tangible assets, or 1% of carrying value of tangible assets. So this complex architecture gives different types of incentives to countries to design their incentives and their different regimes. And Sweden is one of them. So here I was asked to say a few words about this. I would say historically, it's been a country with a lot of innovation. It's a small country when it comes to the population, but not when it comes to the number of headquarters and I would say the unicorns and all the R&D that takes place in this country. And perhaps surprisingly, there hasn't been like a very strong R&D incentive. There hasn't been a patent box. The nominal rate has been relatively, I would say, in line with international standards. Well, now we have 20.6%, which is not particularly attractive, not either discouraging, I would say, and to some extent, interesting rules when it comes to passive income. So there are some incentives into investing into Sweden, but no strong incentives when it comes to R&D. In this respect, it's been considered that Sweden should improve the situation, and a twofold proposal has been put forward earlier this year. So two proposals. The first one is like a super deduction. Here, you would be able to deduct 300% of the R&D salary cost. So each euro that is spent in R&D salaries, you got, in addition to that euro in salaries, you got 2 extra deducted as a super deduction. So it's of course an incentive in like hiring people working with the R&D and being dedicated to such projects. Of course, there's always a question of definition, and that's one of the reasons why we have this suggestion. People need to be working with the R&D. In the past, we did have some form of, I would say, reduction of social security contributions that exists, and that's combined to I would say a small reduction of the personal income tax. So there are some, I would say, nuances to the Swedish tax regime when it comes to R&D, but it's very limited. So here, this new regime would correct one of the drawbacks of the existing social security reduction, which supposed that companies would really identify who's doing what, who's working on R&D, to what extent, how to define R&D, how can you prove that research indeed is being developed, is being provided, that indeed there are developments of new products and services. That has been the reason for a lot of disputes, and in the end, fewer investments and some companies choosing to invest in R&D projects outside of Sweden. Here, I will not name companies, but there are famous ones that have chosen to develop certain products, certain services outside of Sweden in different countries where they found that the incentives were either more attractive or more foreseeable. So it's not necessarily only a matter of attractiveness, it's also one of foreseeability. So that has been a problem. In this respect, the proposal I've just mentioned tries to make things easier by not requiring a systematic involvement in research and systematic development, the proof of systematic development of different products and services. It's enough that you have the aim to to be developing new products, new services, or new processes. So the first alternative was the super deduction, 300% of the salary cost. What kind of problems does that raise? Well, if in case you are a startup and you're not profitable, that's a problem because it's not refundable. It will increase the loss carry forward, which is, by the way, one of the reasons why Sweden is still an attractive country. From a corporate income tax perspective, we have an indefinite loss carry forward system. So you can just, accumulate those losses, and if at some point the company becomes profitable, it might benefit from the losses that have been accumulated from the past. Another aspect here is that the increased deduction for R&D would reduce, of course, the EBITDA because you decrease your profits, but that's a problem when it comes to financing. We have in the ATAD we have the general interest limitation deduction at Article 4, which currently in Sweden is limited to 30% of EBITDA. And here, of course, if you can deduct more on the expenses, you reduce your EBITDA, which makes it less, which reduces the possibilities for interest deduction. So that was the first option. Second option is a refundable tax credit amounting to 20% of your R&D wages. In both cases, the wage is not the pension, it's just a wage here. 20%, and that is refundable. So if you are a startup company, you don't have any profits, you don't paying taxes, you can actually get the tax back in cash. Here there are some proposals to reduce the risks of abuse because it's identified in the preparatory works as a potential problem for that system. So here we have those two options on the table. Both are meant to be compliant with the Pillar 2 architecture and of course subject to the SBS system and the substance-based tax incentive proposal. So here the objective is to discuss this proposal. There's been like a round of discussions with different parties being able to formulate comments, and the objective is to implement a final proposal during this year. Another aspect here has been that outsourced R&D is not part of either system. So consultancy costs, if you hire another company and another R&D person, that will not be part of the system. It's been criticized by some observers in this respect. On the other hand, we could say that this is consistent with the modified nexus approach, BEPS Section 5. You should not be able to outsource, you should perform by yourself. Finally, and perhaps coming back to principle of reality, that generous proposal has to be financed, and the proposal here is to finance it by reducing the threshold for the interest limitation deduction from 30% of EBITDA to 20%. So of course that has been criticized, or at least mentioned by the observers as part of the public discussions. And it kind of illustrates the fact that incentives are not always self-financing. It's been a topic discussed for forever. Here there's like I would say a fear that this incentive will not be self-generating new tax revenues, but could be an expense for the state. So that is of course subject to discussion. We'll see how the final system looks like, but certainly some reform I think is to be expected later this year.
Thank you so much, Jerome. I think that what is also very interesting is to see that both are different proposals, but at the same time it raises a lot of concerns and still the fact of incentive, but who is going to give the money. So let's look at Sunil. And I asked Sunil, he has done some work also with Suriname But it is nice to see what type of tax incentives for developing countries with a small population, not necessarily geographical. So, Sunil, I will share your slides. If you have any questions, just ask in the chat. Please go ahead, Sunil. The floor is yours. I will share your slides.
Yes, thank you. Thank you. My presentation is about the Pillar 2 and side-by-side package impact on developing countries with a small population, with anticipated extreme growth from the expansion of the extraction industry following the discovery of oil and gas or minerals. It is not necessarily about Suriname, but most of what I will say applies also to Suriname. And when I'm talking about small countries, that's because they have a small population, and not necessarily about countries small in a geographical sense, to be clear. Well, the focus will be on the perspective of these small developing countries from a tax revenue point of view, and not necessarily the view of the MNE or the headquarters state of such MNEs. So first of all, what are the typical challenges these countries are facing in the context of their corporate income tax system or in relation to the minimum tax? First of all, as said, the growth in investments. Foreign direct investments are coming in mainly from large foreign multinationals, which are in scope of the Pillar 2 rules. And then the corporate income tax system of these countries, generally the design is such that you can say that the rules in the corporate income tax code are often outdated because they are focusing on the local smaller businesses rather than the taxation of large MNEs. Further, what I have observed in discussions with officials of such countries is that BEPS measures, Action 2 to Action 14, are often not implemented or only to a limited extent because of the same focus on local businesses. What we can see further is that the baseline corporate income tax rates are generally high, but MNEs, ETRs are often low because of effective structuring and sometimes because of incentives, although what we have seen is that these incentives are often not Pillar 2 friendly. What about the international tax policy of these countries? To put it simple, these countries often lack an international tax policy, and that is fully understandable because the focus was on local businesses, small, medium-sized enterprises, and not on the MNEs, large MNEs. For the same reason, we see only a limited number of tax treaties, and you can ask the question whether tax treaties really benefit such source countries. Well, the capacity and capability problem of the government of these states. What do we see? It's just like some other categories of countries. There is only a limited capacity to manage the existing rules. Also, in relation to these new incoming investments on a large scale, MNEs are able to reach low ETRs because they are far ahead of when it comes to international tax planning and international tax rules. What we see is that also when international bodies are making well, new tax policy, new international tax policy, the position of this category of countries are not considered or only to a limited extent, I must say that. So, an outlook in view of the recent developments in these countries, the increase in investments in certain industries in these countries, new issues arise in the context of the local corporate income tax system. And what about Pillar 2? Pillar 2, to be honest, it adds another layer of challenges for such countries. they're facing difficulties to manage the existing corporate incomes tax rules, let alone the Pillar 2 rules. So the Pillar 2 rules, the minimum tax rules, what are the policy options for such countries in reality? Not from a fundamental perspective or from a perspective of international bodies, but as such, given the structure of their economy and the challenges they are facing to manage their corporate income tax system. I would say that such countries should not adopt Pillar 2 rules. I have the following reasons for this. The challenge to manage the Pillar 2 rules are significant. The IT systems, staff and staff training, the processing of complex Pillar 2 data, it's not manageable, I think, for these countries. So Pillar 2 is not a real option in practice. And even if a different approach would be taken, like only introducing a QDMTT, it will not benefit this country from a tax revenue perspective, simply because of the nature of the investments. We have the substance-based income inclusion, exclusion in the Pillar 2 rules. And even if a QDMTT were introduced, the substance-based inclusion rule will result in actually no or very limited tax revenues for these states. Further, about incentives, well, generally the Pillar 2 friendly incentives, Martin has discussed that, the QRTC subsidies, cash grants, it's not a real option for these countries because it will result to cash out or a situation with the same effect of cash out. This may be a little different for the QTI, but still, I don't think it is necessary to have a QTI in place where the investments will still come in. So I would say that given the nature of the investments, the extractive industries, incentives are not necessary for these countries because you will lose revenues and the investors will still come in. The oil and gas sector, the mineral sector is very different. Even high ETRs are not stopping the investment. So I would say it's not really a consideration, I think, well, or at least to talk about incentives, because it will not help in any way when it comes to the position of these states. So what should these countries do? I would say instead of focusing on Pillar 2 or on incentives, they should introduce the BEPS standards as hard law. So the impact will be that they will raise corporate income tax revenues and create a higher ETR. And I think that this will be easier to manage than the Pillar 2 rules for such countries. It's still a challenge, but it's an easier way to create a sustainable system. And also the Pillar 2 objectives will be reached. There will be a floor on tax competition because the ETR will rise. And the base erosion and profit shifting will also be limited. And important for these countries, also the tax revenues will increase implementing the BEPS measures. So next slide, please, Emma. So focusing on the side-by-side package, as mentioned, the QTI is not necessary to think about that for these countries because it is not necessary to attract investments, the type of investments that are coming in now. The investment will still come, and it will lead to loss of tax revenues. The side-by-side safe harbor or the UPE safe harbor, I would say this is not a real consideration for these countries because you don't have any MNEs or only a couple of MNEs in these states, headquarters in these states. So this is also not relevant for these countries. And the simplified EDR safe harbor and the extension of the CBCR safe harbor for the country as such is also not relevant. So the whole side-by-side package is not relevant, I would say, as a statement. So my final observations are that the Pillar 2 and the side-by-side regime offers limited or no benefits for such a small developing country with expansion of certain industries. As I said, priority should be given to the web standards implementing in their to be implemented in the local corporate income tax system. And I fully agree with the IMF that we have to think about who actually is profiting from incentives, who are the profiting stakeholders. So systemic evaluation is needed in this respect, and I think that this category of small countries will not benefit from incentives. Two last remarks, actually two questions or statements. Should rich countries collecting top-up taxes share these revenues with these small countries? And I mean the IAR and UTPR taxes. Should these be shared with these small countries? My last comment, should there be a special top-up tax safe harbor for these countries? Because we have one country that has now a side-by-side safe harbor. Maybe we will have a second one, a third one, or fourth one. But what about these small countries? Should they be granted also a special top-up tax safe harbor? These are my considerations, Irma. Thank you.
Thank you so much, Sunil, because I think that some of the questions that you are asking are very relevant. And I think that the idea to have also your presentation and have different views on just when the countries, for instance, what you mentioned, being an extractive industry, very rich, mining oil, gas, what has to be, are these countries still the same under the Pillar 2 and the side-by-side and what they need and the concerns regarding the international tax policy. So let me see whether there are any questions at this stage. Otherwise, I will say, since we have a Q&A plan, but we still not, I will give you 5 minutes just to change a little your eyes from the computer towards something else. So we will have 5 minutes short break, but really 5 minutes, and then after we continue with the geopolitical balance. So how will other large economies will react to side-by-side? If you have any questions, just please ask them in the chat and we can also reply. But I think it's important to have just 5 minutes to get some water and coffee or whatever. Okay, see you in 5 minutes. Thank you all. Okay, so we will continue. Just to let you know, the recordings and the slides will be available soon. I posted now in the chat the recording and the slides from November 20th, before the side-by-side agreement was adopted. And now we have this, and hopefully we will continue with other roundtables. But let's have the geopolitical balance. How will other economies react to side-by-side? And as it was mentioned by Edwin at the beginning today, we do have Brazil candidate almost accepted to the side-by-side. And we have also India, of course, also a candidate and to the side-by-side agreement. So how do we react to side-by-side? That is the question we have right now. If you have any questions, just ask it in the chat. So please go ahead. We will go first with Suranjali Tandon, Associate Professor, National University of Public Finance and Policy in India. And then after Ricardo André Galendi Jr., partner at La Casa Martins Pereira Neto, with Vice Chuveria Abogados in Brazil, Sao Paulo. Now, let's start with Suranjali. Suranjali, thank you so much. And everyone, all the speakers, participants, thank you so much for being here. It's been a long day, but I think it is worth it. If you see the perspective we gave before, it's very interesting. So there is a lot of things to be said. So please, Suranjali, the floor is yours.
Thank you, Irma, for the opportunity. And just before I begin to speak about the side-by-side agreement, specifically, it's good to give context about the Indian market. At the moment, there is a balance of payments issue in India, wherein the country is trying to attract foreign investment. This is particularly happening because of what we're seeing in terms of yields in the US government securities market, and I think some of it Peter spoke about. And so as a consequence of FDI outflow, what we've seen the government do in the last few months, or in the last few weeks actually, is a reduction in the withholding taxes on debt instruments like government securities. And that really brings back in focus on what incentives really mean in the system, and what do we mean by saying that we're going to manage the minimum tax rate going forward. But that being said, Irma, when I started looking at side-by-side agreement and the safe harbors, I believe that, earlier we used to think as Pillar 2 bifurcating the tax system into those that a tax system that's applicable to companies which are large M&Es versus small. I think now there are multiple kinds of tax systems that will simultaneously operate, which is the way the world operates. But that makes me think about whether Pillar 2 has really substantially changed anything in terms of complexity, whether it's been able to harmonize at all. And I think you have spoken quite against the harmonization of tax systems. So maybe we can take that as a positive, that we're not seeing excessive harmonization across the world. But just in terms of design, I think I have, 3 comments, which I think will then relate back to why a country like India might choose to be within the side-by-side agreement, and what does Pillar 2 really mean for countries, and going forward in terms of just compliances. So I think there are 2 other elements which even Jerome talked about, which is you have a simplified effective tax rate and you have the qualified tax incentives. Just on the simplified effective tax rates, wanted to say that the side-by-side package, it's been implemented. This is an important feature of it. The question is that if the simplified effective tax rate allows an M&E to elect the way of calculation, is it possible that the entity under the simplified effective tax rate sort of moves out of it? So there is the possibility that if that rate is not applied in a particular year, it won't apply for 2 years. There's some complexity around that, and the M&E shifts out of the simplified effective tax rate, which basically means that there are entities that will move in and out of the system. The complexity created for domestic administration in countries like India is to keep a track of whether an entity is within that elected system or not. And I think to a particular issue that I think would be a problem is that there will be a need to clarify the application of domestic law in terms of when these are triggered. There also needs to be specific clarity on dispute resolution, because let's say the UPE is of the view that this is an entity which should be elected for a simplified effective tax rate based on its computation, but there is a disallowance of expenses in a jurisdiction or a country like India, and one of the most disputed items under the Income Tax Act in India are disallowed expenses. So how does one resolve this conflict where an UPE is already elected for a simplified effective tax rate? I think the second issue that particularly concerned me was that there are accounting differences. So, and we spoke about the QDMTTs, they may be implemented, but at the same time, you do have the simplified effective tax rates, and how do accounting treatment differences across these two interact. It needs more thinking and clarification. On the point about incentives being offered, and I think that's a bit of a relief for countries like India, because there was thinking around giving incentives to data centers and technology-driven companies. And we've seen that that's been linked to expenditures in production, which I believe would qualify under the QTI. And so that, in a sense, takes care of ensuring that there is substance. But at the same time, there are also incentives available to corporations on taxes. Now, specifically speaking about the safe harbor, of course, there are ways of qualifying for this. And it's mentioned that a qualifying jurisdiction would be one which has the corporate tax rate, which would be at least 20%. They have a MAT with no material risk of reducing their minimum tax below the 15%. They have a worldwide tax system. And, there is, in this context, there's the calculation of the effective tax rate. Now, for me, the question is that, there are different jurisdictions that are applying different kinds of regimes. So just thinking about it from the perspective of India, one of the largest, I would name three largest sources of foreign direct investment into India. One is Mauritius, the other is Singapore, and the third is the US. Now, on the one hand, you have the US wanting the side-by-side agreement to apply. Mauritius, on the other hand, has opted for a QDMTT, which is still not enacted, but there's no mention of the IIR or the UTPR. And then the third, Singapore is also opting for its side-by-side agreement. What this creates is that there are different kinds of versions of tax regimes that will simultaneously exist. And it's not just complex in terms of direct investment. A lot of the investment from the US or other jurisdictions could pass through Mauritius and Singapore. So the query that I have is that how do these layers of transactions interact? So, for example, investment coming through the US, but through Singapore, but ultimately from the US, which system would apply for operations in India, and how would these interact in terms of applying minimum taxes is a question that I want to raise to the crowd. And also sort of, I think India would need clarity on this particular aspect. I think the other one that I wish to raise is that there is lack of any legislation at the moment in India. So we've not really built in Pillar 2 into our regulations. I believe that I suppose they want to look for the side-by-side agreement as a way forward. And another question, which is, I think, the final question that I want to raise, is that while we have different kinds of side-by-side agreements, these also offer alternatives of routing investments through jurisdictions which may have a more lax way of defining how incomes are taxed globally. That being said, of course, 15% is the minimum tax, but how are the effective tax rates calculated for the purposes of minimum tax under each of these regimes can still allow investments to pass through certain jurisdictions? And how does this really interact with the existence of anti-avoidance rules? So the complication will be that, what in an instance may still be considered as egregious tax avoidance. And ultimately, in terms of India or Indian companies, the exposure or the requirement of Pillar 2 may be less, as as per my last calculation, the share of companies that are Indian and covered by the global minimum tax, or in the Forbes 2000 list to be precise, by sales was 1.74%, and the number of companies was 2.5%. So they're fewer. But of course, in terms of administration, this could be an added cost. So I'll stop there, and thank you, Mima.
Thank you so much, Suranjali. I think that I'm amazed how many different perspectives, but also the different strategies of the countries. And that's the reason why when we started with Peter Hongler, we say, what is the policy options? And actually, having all of this is kind of a very nice compendium of all the policy choices that we have. And I think that I think it is really interesting to see all of this, and hopefully it's also useful for the audience. And I will go to Ricardo. Please give us the perspective of Brazil. Definitely last, but definitely not least, because I think that the Brazilian reaction, it would be very also interesting. So thank you. Please go ahead, Ricardo. Thank you for being
here. Thank you very much, Irma, for the invitation. I believe you can all see my screen in
Yes, we can.
full screen mode. Okay. From the Brazilian perspective, what was the reaction? I believe that there is a lot of interest on that because Brazil applied for the qualification for the side-by-side safe harbor recently, and the perspective on that is really positive. So I personally believe that it will be accepted. I don't see a reason why it would not. But this is not necessarily good. Okay, so I'm a bit surprised by the way that things are being shared over internet and so on, in the sense that this would be a tremendous thing for Brazil. Wow, we are now qualified for the SDS safe harbor. So my perspective here is a bit less optimistic on that. So let me start by describing what we currently have. So we have a so-called TBU regime, a worldwide taxation regime. So it's common that in international tax scholarship, we are asked to describe the Brazilian CFC rules. And what we answer is that we don't have CFC rules. We have something else, which is broader, which is not target to abusive behavior. So if you have a parent company in Brazil with a subsidiary abroad, the profits of the subsidiary will be taxed yearly at a 34% rate. Okay? There is no exception for highly taxed income, for active income. For Brazilian purposes, it doesn't matter. Okay, so this is why we say this is not a CFC rule. We are not targeting the deferral of taxation by the interposition of base companies and so on. This is not the Brazilian regime. There is indeed a deemed credit of 9% in case of certain sectors, but in fact, what this does is to drop the rate to 25%. And please consider that I'm talking about here the general regime. So it is possible that you're talking about a financial institution, the case in which the tax rate applicable would be 45%, up to 45%. Okay, so we are obviously the only country in the world with such regime. It's a terrible universal basis taxation regime. There has been a lot of struggle to reform this for 20 years already. So since the rules were enacted, a bit more than 20 years. And then Pillar 2 came out. So we had this scenario in Brazil and Pillar 2 came out. And the first reaction of Brazilian authorities was to enact a QDMTT. So Brazil has a QDMTT, which was enacted in 2024. This was a by-the-book adoption, so we are qualified for the QDMTT safe harbor. It's acknowledged in the central record, no issue with that. But what the stakeholders wanted was that along with the adoption of the QDMTT, that rule, the TBU rules, the worldwide taxation rules, would be reformed. So what the taxpayers in Brazil wanted, okay, we can adopt the QDMTT, but please reform the TBU rules and transform them into an actual CFC rules in the terms of BEPS Action 3 final report and an income inclusion rule. So what I'm saying here to you is that we Brazilians, taxpayers, from the side of companies, we would take at any time a CFC plus an IIR over what we currently have. Okay, it's a no-brainer for any company you ask in Brazil. We would take this change at any time. So what we achieved was that an article was included in the QDMTT legislation, obliging the tax authorities to submit a bill, proposal for reform of the rules in the first semester of 25. And this never happened. Okay, so what we see here is that there is a willingness of Brazilian taxpayers to change their current rules, even if it means to adopt a CFC rule and an IIR. And on the other hand, tax authorities refuse that. They don't want that. It's a lot of tax collection for them, so they want to collect revenue from the activities being performed abroad, even though this means killing the competitiveness of Brazilian multinationals. And why do we believe that there was no legislative proposal? So we're talking about the first semester of 25, and what happened is that the side-by-side G7 statement came out in June. So when I think about side-by-side, I always think about this fridge. So for me, I think about the fridge which has a freezer on the one side and the actual fridge on the other side. And the G7 statement said that M&E groups with UPE in the US will be exempted from IIR and DTPR. SBS would not allow for distortions, and Pillar 2 would be simplified, and there is some simplification measure in the final package from January, and the treatment of tax credits will be adapted, and that's what started the discussion on QTI. So what we see here is that there was this assumption that the American regime would be equivalent to Pillar 2. So this was in some sense, the assumption behind the SBS package. But when we take a look at it, we see that they are not really equivalent, and this was already addressed by Professor Peter Hongla, mainly because Pillar 2 has jurisdictional blending, and the American NCTI has a form of global blending, and this is very important because Pillar 2 is essentially a measure against tax competition. So if you use global blending the way the US does, you still allow the usage of tax havens in order to reduce your global effective tax rate. Pillar 2 is the one effectively addressing the issue of low tax jurisdiction, and it's not possible anymore to explore them, at least in the extent that it was before. Okay, there is a difference of rates, so a 15% rate in case of Pillar 2 of minimum tax. The rate of NCTI is around 14%. It was lower before the OBBBA. And there is a difference of tax credits. So the US regime has credits for R&D, which I will not address in detail here. Globe has the QRTC and now also the QTI as measures to diminish the impact of Pillar 2 over tax incentives. But my point is that there is clearly a side of the fridge which is colder than the other. So there is one side that freezes competition, and the other side that is more beneficial to competition in some sense. In my view, the more beneficial side is clearly the US side. I believe this was also the impression which was strongly made by Professor Peter Hongler, but we see in the literature nowadays some American authors saying that this is not true. Even there are even authors who argue that the American regime would be more burdensome than Pillar 2. What we see in practice is that in Europe there was already a letter from PwC to the Dutch legislature, and they said that there is evidence that Europe is being harmed by the adoption of the current rules. So MNEs are planning to relocating their headquarters not only to the US, but outside Europe in general. And there is also the shifting of valuable activities such as R&D. And what we see now is that there is a clear sign that SBS is already fooling tax competition, and this is the opposite outcome expected from the Pillar 2 project in general. So when we take a look at this scenario, in which side of the fridge is Brazil in? So do we have jurisdictional blending or global blending? We have limited blending. What we have for Brazilian purposes is that if you have losses in a listed jurisdiction, generally for the purposes of the exposition tax haven, you can't compensate those losses with profits from high tax jurisdictions. Okay, so it's worse than jurisdictional blending, of course. It's worse than the NCTI global blending. What we have, as I showed, is not a 15 or 14% rate, is a 34% rate, okay? Which can be lower to 25%, but also can be as high as 45% in the case of financial institutions. And we do not have any kind of credits for tax incentives. Okay, so which side of the fridge are we in? I wouldn't say we're in neither side. We're in North Pole. We are in the Antarctica. I don't know. We are far beyond the fridge already. So will Brazil qualify for the SBS Safe Harbor? So SBS Safe Harbor qualification demands eligible domestic tax system and an eligible worldwide system. We have a QDMTT, so number one check, no doubt about that. And the question is whether the TBU rules are an eligible worldwide system. And I cannot see why they are not. So it's a comprehensive tax regime applicable to all resident corporations on foreign income, which is imposed on a broad ways, active income and passive income. There are no income exclusions at all. So I don't see any material risk of being taxed below 15% on a global basis. I have a really big limitation on seeing how the Brazilian regime would not qualify as an eligible worldwide tax system. And as we all know, it was mentioned before already, Brazil has formally requested the qualification for the SBS Safe Harbor. And we have some words from the Brazilian tax authorities already. And here I quote, I have the source in the end of the slide. So in the short term, there will certainly be no changes to Brazil's worldwide taxation regime and no income inclusion rule IRR will be introduced. So what I started with mentioning that there was this expectation for reforming the TBU rules. So SBS killed the momentum for that. So now Brazilian authorities are really happy because they have a reason to keep the TBU rules. Okay, so things will be kept as they are because now we can qualify for the safe harbor. See how good that is. And once the tax regime has been certified as allowing jurisdiction to qualify for side-by-side treatment, any amendments to the features that were addressed would likely trigger a reassessment by the OECD. So once Brazil achieves the qualification for the SBS, so the discussions on the TBU reform will be basically killed. See, so Brazilian authorities are really happy with everything that happened because they will keep taxing foreign companies on a broad base. And at this point, from a tax policy perspective, we have discussed a lot. We have tried to show how harmful this is. So we have several examples of tax inversions in Brazil. Startups, no startups in Brazil start from Brazil. They will go to Uruguay probably. So that's how you structure a startup company in Brazil nowadays, because otherwise you are subject to this terrible regime. Okay, and here I come to my conclusions. So Brazilian TBU rules qualifies for the SBS safe harbor. This is my personal opinion. I believe it will be confirmed in the next weeks. This is, however, a bittersweet outcome. So the SBS harms the momentum for the Brazilian TBU reform. So as I showed you, the QDMTT brought the expectation that the TBU rules would be reformed, and I don't see how this happening right now. So as a last message, being on the right side is not enough. We have to be on the right side for the right reason. And Brazil may perhaps be on the right side of SBS, of the side-by-side package, but for the completely wrong reason. And this was my presentation. Thank you very much.
Thank you so much, Ricardo. You gave us lots of thoughts and a kind of pessimistic view to finish the roundtable, because actually countries, you should be careful what you wish for. And still, if you say, well, we have the safe by safe, the safe harbor is still okay. I want to give still 5 minutes to all the other speakers to react to all of this, to give final comments and to say, let's go ahead with all the pillar 2 side by side, of let's think about it. What is in one sentence? What is the key message? And for the speakers who are here, I know that some people will have to go immediately, but for the ones who want to comment on that, and I would just wanted to go first to Edwin, because actually you were also quoted in the tax notes saying, well, PwC says that companies are going away and leaving to the US. Not you, but PwC, I say. But let's have a kind of some final remarks on this. And if you have any questions, just ask them in the chat. But I want to give an opportunity to the speakers. I know, Martin, you have to leave. No worries about it. I just wanted to give first the word to Edwin. And if I can go then after to you, but if you are already gone, it's okay, no worries. Edwin, please go ahead.
Well, all the speakers, I think, amplified, what I think, poor taxpayer, poor multinational. It's chaos, We have legal uncertainty. We have very complex compliance requirements. We have Pillar 2 minimum tax system, popping up. If countries are going to rethink their competitive position, maybe repeal the Q from the DMTT, but still protect their taxpayers against top taxes. It's a very difficult landscape, to navigate through. And it also shows, I think, that tax competition has not gone by Pillar 2. Some rate competition has gone maybe, but it has been replaced by something else. And on the letter to the legislator, for Peters and Helens, SBS triggered some thinking by clients, but the picture, of course, is more complex than just side by side alone. It's also, the business friendliness of the US versus, I think, the business friendliness of the EU. Well, the Commission is, I think, trying to change base, and saying, well, we need more and a better business climate. Think of the simplification package that is reported upon. But still, people, I think, do not always genuinely believe that tide is really changing in the European Union. So it's a lot of technical, legal, but also more soft facts, that influence this landscape.
Thank you so much, Edwin. I give you just, perhaps you have time for one sentence, Martin, before you have to leave.
Yeah.
But it would be nice to hear from you.
Yeah, sure. Yeah, sorry for having to leave early. My kid, one of my kids, my daughter, she's going to field hockey, so I have to bring her to hockey practice. But yeah, just a few words. I really liked Mr. Galendi's introduction. It's cold in the US. It's even colder in Pillar 2, but in Brazil we are in Antarctica. So that was really funny. Thank you for that. I was also intrigued by Sunil's introduction on foreign direct investment, influx of investment coming regardless of the incentives. When you look, for instance, at extractives, when you strike oil, I tend to think that as well. But nevertheless, I think it also depends on the elasticity and the type of sector. So if the economic rent you have available in your country is location specific, I can imagine when you strike oil, then there's less elasticity when it comes to securing foreign direct investment. But if your economy depends on more mobile investment, I can imagine that elasticity is greater, and then even particularly developing countries, routine activities, then you will need to compete also as a developing country, I can imagine, and then the incentives become, I guess, more relevant. So indeed, I would agree, but it all would also depend on the elasticity of your sector of industry, and the more elastic it is, the greater the importance and reliance, I guess, the importance and of incentive regimes are. I guess, at least intuitively. But it was really interesting. So yeah, and I also saw indeed the PwC piece in text notes. So I was also intrigued by that you already see this momentum already popping up. So thank you.
Thank you so much, Martin. And let me just go for Jerome. Would you like to give some final comments? There is a question in the chat, but I think that if someone can reply on that one, yeah, please go ahead, Jerome.
Very shortly. I think there are many lessons that we can draw from this whole story. Hopefully, law will come back. Politics have taken the floor, but we have those. We have the UTPR, the Belgian case. We have, as I think Peter started with, legal disputes around the globe. Of course, I like the play on word. I hope law will come back and help us find solutions and secure solutions, I would say, for the future. The lesson of this project is perhaps that we should take the time to think things through before acting. Hopefully, I make a parallel with the UN project. Hopefully, they will draw on this example to discuss, to secure solutions before spectacular announcements are made. Final lesson is, I guess, that tax competition simply never disappears. And as long as our treasuries are national, tax competition probably has to remain. I stop here, I think.
Thank you so much, Martin. Let me just give the word to Sunil.
Thank you, Irma. I fully agree with the previous observations. Also with what Martin said about countries depending on foreign investments, and I was focusing purely on these small countries with minerals discovered in recent times. But I fully agree with your comments, Martin. And just one more comment from my side. I fully agree with the previous comments, and that is what Peter said. Pillar 2, it's an implosion, I would say. We should start thinking to unite in giving some pushback on this. I know that it's happening in academia and in practice, but still, maybe we should unite and give more pushback on this project. But because in the end, who is actually benefiting from the Pillar 2 rules? Question mark. That are my comments, Emma.
I completely agree. Thank you so much, Sunil. And let me just go to Andrea. Then after we go to Suranjali, and finally, Ricardo, you take us to Antarctica. But first, Andrea will take us to still a little nice weather. Okay, please, Andrea, go ahead.
Yes, more or less here it's quite cold. I agree with everything that the colleagues have already said. I think that for countries like mine, we should focus on what is good for our country. I think it has been a good thing that Pillar 2 made countries finally, I don't know, seriously revisit, their tax incentives, because this is a historical issue, that I was reading yesterday a document from the Inter-American Development Bank, where the conclusion was that to improve the quality of tax incentive policies, it says governments should adopt systematic ex-ante assessments and ensure that incentive design is target efficient and based on clear economic rationale. So I think that countries like ours should focus on what is good for them. It is insane to follow all the evolution that the Pillar 2 has had. I agree that we need a stable system, but at least, and I come to your first question about if I still think that it's not time to implement a QD entity. So thank you.
Thank you so much, Andrea. I think that it's important to see also the Platform for Collaboration on Tax has also published a toolkit on tax incentives, where it has taken also away the attention to the Pillar 2 and just going to the design of tax incentives and the governance. Yes, please, Suranjali, go ahead.
Thanks, Irma. I think all has been spoken. Just want to reiterate the fact that the side-by-side agreement still leaves a lot of room for countries to design their minimum taxes and their laws in line with what their strategic decisions in terms of their economy may be. We've seen that specifically Ricardo showing the difference between jurisdictional blending as well as like an specific jurisdiction-wise effective tax rate. So I think what might arise is a more nuanced kind of tax competition, where you have the design of novel sort of tax systems where this is still possible. And I think for developing countries, just the structuring of these transactions through specific jurisdictions is of interest going forward. Thank you.
And I give the word to Ricardo and then the final word to Peter Hongler. Ricardo, please go ahead.
So thank you again. I believe that Pillar 2 is all about tax competition. So the idea behind the whole conception is tax competition. My presentation is more in the sense that why Brazilian tax authorities feel that Brazil is immune to tax competition. So they behave as if we were immune to tax competition. We don't need to compete. But as I see it in the international scenario, Brazil is mostly the only country behaving this way. I don't see a similar behavior in other jurisdictions. And what side by side does is to challenge the level in which tax competition will be addressed. So I believe that Pillar 2 addresses tax competition on a higher level than the US regime. So in a sense, the level has been diminished. And the challenge now is to understand whether Europe will remain trapped in the higher level that was initially negotiated. Because now we have a legal problem that Europe is trapped in that higher level, and a lower level for the US and other jurisdictions who want to qualify for the SBS safe harbor was made possible. So that's the scenario as I see. Thank you.
Thank you so much. And for the final word to Peter.
Yes, I think now we have moved into a next phase with respect to Pillar 2, and it's probably the abolishing phase. Honestly, I believe there is no way that Pillar 2 is going to stay here for long. And in that, environment, I think policymakers, consultants, and companies need to make sure that, they do it in the most efficient way, the unwinding process. And I think we have just started with it now. But for sure, this is not going to hold for the next 10 years because the legal risks are just, unsurmountable, and you can't change it because of the, failures in the beginning when it was designed. Thank you.
Thank you so much, Peter, and thank you so much, everyone, for staying with us until the end, for the participation to the speakers. I know some speakers had to leave, but we appreciate that you stay, and hopefully we will continue organizing these roundtables. But yes, let's think about what is Pillar 2, what is side by side, safe harbor, and let's think about the policy choices. So thank you, everyone, for being here. And please, we will share the recording once available and the slides that are available. Thank you, everyone.
Thank you very much.
Bye.
Thank you. Bye-bye.
Bye.
Thank you. Bye.